Welcome to Friday Takeaway. This week, we take a look at two oil and gas players, Hibiscus and Hengyuan. But first, Trump lost another advisor this week, his economic advisor Gary Cohn, which made the market nervous. Apparently, Cohn was seen as a steady hand formulating economic policy, and after Trump's sudden tariff move, the uncertainty over whether a trade war is coming is worrying. It seems President Trump's White House is getting emptier, and his affairs are getting messier, especially after the news broke that the porn star Stormy Daniels is suing him. The Wolf of Wall Street producer Red Granite Pictures has agreed to pay the US government $60 million USD in relation to 1MDB. However, this is not an admittance of any wrongdoing, and he simply wants to focus back on business. Another interesting development. Australia's PM's son Alex Turnbull allegedly was sidelined at Goldman Sachs after he had blown the whistle on questionable deals at 1MDB. Now, Bank Negara Malaysia kept the OPR unchanged at 3.25%, as it expects the domestic economy to remain strong. Back at home, KLCI dropped 0.79% to 1,841.4 points this morning from last Friday. That's because of stronger foreign outflows this week. However, Ringgit is now stronger at 3.91 against the greenback. As oil prices recover to over $60 a barrel, the question is, do you go up or do you go down? So this week, we decided to look at two players that have had some interesting movements, Hengyuan and Hibiscus, to see who has a better prospects. So let's delve deeper. While the man on the street might not know Hengyuan, in his former life it was known as Shell Refining Company up till last year. An upstream player, it refines, manufactures and sells petroleum products such as LPG, jet fuel, diesel, and has a 51% stake in a refinery at Port Dickson. So what's so hot about this company? Hengyuan's full-year earnings jumped 2.7 times to 909 million ringgit in FY17 due to higher refined product market prices. In fact, it achieved its widest gross profit margin in 20 years at 12.4%. Hengyuan has been under heavy selling pressure despite the good earnings, as evidenced by its shares dropping 38.4% from a high of 15 ringgit 10 cent in late February. The worry is the delay for its new refining facilities, namely the Euro 4N Mogas project, which may mean a loss in revenue as the October 2018 deadline to implement Euro 4N gas inches closer. This morning, it was trading at 9 ringgit 30 cent. Now, no analyst covers this stock, but it was a star performer last year, with share price increasing over 200% to about 16 ringgit at the end of last year. But it is highly volatile. On average, its share price last year was 8 ringgit 42 cent and its lowest was at 3 ringgit 40 cent. Hibiscus made its debut in 2011 as the country's first SPAC, but has since graduated to become a full-fledged oil and gas firm when it acquired its first asset in 2012. It has operations in the Middle East, Norway and Oceania region. Its 78.3% owned VIC P57 JV has been granted a 5-year renewal term from an Australian oil authority. One of its fields, Felix, has a best estimate prospective resource of 24 million barrels oil recoverable. Andy Kenner-Pereira says that the Australian gas market is currently undersupplied. But if you're looking for a steady dividend player like some of the bigger oil and gas boys, you're out of luck. As Chairman Zainul Rahim Muhammad Zain says, it will not be paying dividends as it still needs money to invest and grow the business. Share price went down 0.13% to 90 cent from 1 ringgit 4 cent last month. Most analysts are positive on the stock with 3 buys and 1 hold, with target prices ranging from 97 cent to 1 ringgit 48 cent. Public research in particular increased its target price slightly to 1 ringgit and 8 cent. But it is positive on Hibiscus' long-term prospects as it is constantly looking to increase production levels.